Okay, good morning. Welcome to the Teachers Retirement Board Investment Meeting of December 3rd, 2020. I'm going to start by calling the roll. John Adler,
I am here.
Thomas Brown,
Here.
Natalie Green-Giles,
Here.
David Gazansky,
Present.
Russell Buckley,
Here.
Deborah Penny,
Here.
and Susanna Vickers.
Here.
All right, quorum, and I'll turn it over to the chair.
Good morning, everyone. And on the record, happy birthday to Thad McTeague and Natalie Green-Giles. We're very appreciative that you decided to spend your birthday morning with us. Yeah, absolutely. Okay,
A
the
lovely
first thing
group to be with. Thank you.
we appreciate it. First on our agenda is the passport funds. And we'll go to Robin, or will we go to Emma?
I think Emma can lead this.
Okay,
Thank you.
perfect. Emma O'Brien from Rocketown. Thank you.
Thank you, and good morning, everyone. We do have a pretty tight agenda today, so we were planning to just hit the highlights in terms of performance for the month of October and preview what happened in November. We did include the September quarterly report in the materials, but not planning to go through that unless there's any questions, just given the time constraints. Hearing none, we'll go on to the October monthly performance report. So just to spend a minute on what happened in markets in the month of October. At the November meeting, we had talked about how there were two major themes that we had seen in the market start to reverse in September and October, and we saw that continue through November. So that's value had finally started to outperform growth, and small cap had finally started to outperform large cap. October was an interesting month for markets. In the first half of October, we saw positive performance from equity markets, and then we saw a sharp sell-off in the second half of October as there were rising COVID cases and hospitalization rates, and we also saw the reinstatement of some lockdowns within Europe. The S&P 500 had its worst week the last week of October since March, despite the fact that we had seen some strong economic results coming in. The S&P finished the month of October down 2.7%. If we look at non-US markets, so international developed, these lagged US markets due to the fact that we had more serious COVID concerns. The UK and France had gone under stricter lockdowns during the month of October, and the international markets returned negative 4% for the month. Emerging markets outperformed US and international, mostly driven by Asia exposure, and emerging markets finished up 2% for the month of October. Fixed income markets were relatively flat as we saw yields increase, but spreads tightened a bit to offset that yield increase. So if we think about how that translates into your performance for the variable funds, so if you're looking at the first page of the monthly report, the diversified equity fund was down about 1.8% for the month, beating the hybrid benchmark return of 2.2% and the Russell 3000 return of 2.2% for the month of October. Looking at the underlying components of that, the passive equity composite was in line with the benchmark. The defensive strategies composite was down about 60 basis points for the month of October versus 1.7% for the benchmark. And that was really driven by strong relative performance from your convertibles managers within that defensive composite. Your actively managed US equity composite benefited from having a small cap value bias in that portfolio. It was up about 70 basis points versus the Russell 3000 index return of negative 2.2. I'd also add that as follow-up to the discussion we had 2 meetings ago, we're going to have 2 managers present as the next portion of the agenda, and those are 2 active US equity managers. So it'll be interesting to hear their views on active versus passive. And then lastly, within the international equity composite, down 2.15 for the month of October versus down 2.5 for the benchmark. So continued strong performance from your international equity managers. The balance fund had about 512 million as of the end of October, was down 74 basis points and was in line with the benchmark. As a reminder, the 2 underlying strategies within this balance fund are index funds. International Equity Fund had about 180 million as of the end of October, As I mentioned, performance continues to be strong from your international equity managers. They're outperforming the benchmark by over 300 basis points year to date. The Sustainable Equity Fund, down about 50 basis points compared to the benchmark return of negative 3.4, so outperforming by almost 300 basis points. This is a strategy that is underweight some of those large tech names that you saw sold off in the month of October. And then lastly, your two equity funds, equity index funds, excuse me, the US Equity Index and an International Equity Index, down 2.5% each. Over the year-to-date period, we have seen some tracking relative to the benchmark. This is due to some large cash flows that have occurred in March and as well as September, but the underlying index funds are performing in line with the benchmark. So I'll pause there and see if there are any questions on October performance.
Any questions? No? Okay, I guess you're good to
Great.
go.
Okay, and then I just wanted to spend a minute on the November benchmark report. So if you could open up that attachment. November was a historically strong month for public equities. Despite the fact that there were rising COVID cases throughout the month of November, we also did get some positive news on the vaccine front from Pfizer and Moderna. And on top of that, markets reacted favorably to the US elections, the outcome of the US election. The S&P 500 was up 11% in the month of November, which was the best November on record for the S&P 500. As I noted earlier, we saw another month where value outperformed growth, small cap outperformed large cap, which should bode well for your diversified equity fund as we start to see performance results roll in for your managers. Value outperformed by over 3% in the month, still had pretty wide dispersion year to date. Year to date growth is up 32% versus value, which is down 1%. Small cap stocks, very strong performance during the month of November. They were up about 18.5%, which outperformed large cap by about 7%. We also saw strong performance from international and emerging market equity markets. International markets were up 15.5% in the month of November, and emerging markets were up 9.3%. So really strong performance across the board for equity markets. Saw positive performance in fixed income markets. The ag was up 1%. Yields did not move materially, and spreads did tighten a bit, which contributed to that performance. And you could see how that translated into strong performance for the benchmarks within the variable funds. So the Russell 3000 for the month of November was up 12.2%. The diversified equity fund hybrid benchmark was up 12.3%. If we go down to the international composite benchmark, up almost 14% for the month of November. Any questions on November market performance?
No, guess not.
No? Okay, great.
All right. Okay, so then we're ready for the Vanguard presentation. So Liz, do you have to let them in?
Can I just make a couple of remarks before Vanguard and Wasatch present? Emma just referred to the fact that this is intended to be a continuation of the conversation of the board discussion that was held 2 meetings ago regarding active management within the variable funds. And as you may recall from that board meeting discussion, there was a fair amount of data presented about active manager performance in general relative to index strategies, as well as the performance of the US active composite within variable A, which you may recall is about 10% of variable A today. And I think during that presentation, the outperformance, the general outperformance of index strategies versus actively managed strategies was clearly apparent in the data. The wide dispersion between growth and value, large and small, was very much apparent during that data. And I think one could reasonably argue that the data, the historical data, particularly over the past decade, presented a fairly strong case for indexing. So we thought, and we've had discussions with TRS staff about this, of course, we thought that closing the discussion out with a fairly, with the focus being almost exclusively on historical data, might not be a full presentation of all of the relevant information. And so what we thought might be useful for the board is to hear presentations by a couple of firms about why the future might be different than the prior decade. Why secular changes as well as macro changes in the economic environment, as well as the global capital markets, might argue that active managers might offer greater opportunity for additional return relative to index strategies. So with that in mind, with a forward-looking perspective, we thought it might be useful to invite a couple of third-party firms in to speak to the board. The first is Vanguard. Vanguard manages the components of the balanced fund today. And although everyone thinks of them primarily as an index manager, and they are one of the world's largest index managers, they also have a fairly large business in providing actively managed funds for investors, some of which they manage internally. They manage quantitative strategies internally, but they have a big business in researching and retaining third-party managers, which they bundle together inside of mutual funds to offer to retail and institutional investors. So they have an interesting, I think, perspective on both active and passive management. The second presenter is Wasatch, which is a small cap growth manager for the board for the variable funds. And they certainly have an interesting perspective on opportunities, particularly at the small cap end of the U.S. equity market. So that's really the logic for inviting these two firms in.
Robin, before they go on, could you just repeat that again? So we're talking about 10% of our variable funds, and about how much money is that? Just so we are clear how much we're talking about.
That's Emma, you probably have the document up in front of you. So today, the active composite today is 1.6 billion. At the end of October, it's 1.6 billion of the variable A funds, 15 billion.
Okay, thank you.
Any other questions before we invite Vanguard in?
Yeah, because we also have actively managed in the defensive composite, right? Is that
yes?
That 1.6 is in addition to the defensive composite?
Yeah, the defensive composite, though, I guess I separate that out, although it's an important topic, but I think it's a different topic in that in the defensive composite, a small portion of it is U.S. equity. There are convertible managers, there's global TAA, there's some low vol U.S. equity, but it's much more of a mixture of a variety of strategies, which is our next, will be our next topic once we finish the discussion on U.S. equity. So I think it's definitely actively managed strategies, but it's not dominated by U.S. equity.
Okay, thank you.
Anything else? Great. I think Vanguard should be in the waiting room, Liz.
They're in.
Great.
Great.
So James Martielli is on the line, as is Valerie Beauclair. So maybe you could introduce yourselves, and the floor is yours.
Great. Thanks so much, Susan, and as well as Robin. My name is Valerie Beauclair, and I am a Senior Relationship Manager at Vanguard and the primary contact for teachers retirement, and have had the good fortune to work with your organization for over 2 years at this point in time. And we thank you today for allowing us to talk to you. If Vanguard is actually headquartered in Malvern, Pennsylvania, we have over 19 global offices, close to 18,000 crew members, and over 30 million clients worldwide. We appreciate your continued confidence in Vanguard and your partnership with our organization. Joining me today, as we had mentioned, is James Martielli. James is heads our investment solutions department, and I'd love to let him give a little bit more detail on himself.
Great. Thanks, Valerie. So again, thank you for the opportunity to present. My name's James Martielli. I lead a team of investment specialists that are really focused on creating custom portfolios and delivering evaluations to clients and their consultants. Me personally, I've been in the investment business for 25 years, and over 20 of those years have been really doing investment manager oversight and search. I've probably talked to thousands of investment managers over my career at this firm and at Vanguard and another firm. And Robin and Emma have done an excellent job providing the background. So what I was hoping to do was take about 10 minutes or so to give you a little bit of background on active, and I don't know if Robin or Emma, if you do have the presentation, if you can
Everyone
share
has
that.
the presentation.
Okay, that's great. So I'll cue on the slide. So maybe after about 10 minutes or so on slide 6, we have a couple of questions to pose, and I'd be happy to take any questions throughout. So if that sounds good with everybody, I'm seeing at least one head nod. Why don't we just go to slide 2? So Robin, thank you for providing some context. This is some of the context on Vanguard. We are not just an index manager, but the third largest active equity or active manager, according to Morningstar. And about $670 billion is actually outsourced to third-party managers, 26 different managers, including some you're probably familiar with: Wellington, Schroders, Bailey Gifford, PrimeCap. And we've been pretty successful over the years. Over the last 10 years, if you asset weight all of our composites together, or all of the funds together, we've added 48 basis points over the last 10 years, 170 over the last 20 years. So we truly are agnostic when it comes to active and passive. It really comes down to what works best for the client. So if folks have the presentation, if you just turn to slide 3, we try to boil things down into, okay, if you're going to be successful in active management, like what do you need to do? Well, first, either you or your consultant needs to really identify talented managers. Of course, that's not easy. Really, it's about identifying, does a manager have an edge? It's not just about having a good manager, because it's a competitive world out there. So do they have an edge? And do you believe that edge is sustainable? I also want to note, costs do matter. So it's not about finding the lowest cost manager, but as Mr. Bogle likes to refer to as the tyranny of compounding costs. So the higher the cost, the higher the hurdle. So it is something to consider. And then I want to spend a little bit of time on patience. It's a very easy word to say, but it's a very difficult thing to practice. So I just wanted to share with you, a few different stats when it comes to patience. We've done a lot of research on this. So if you turn to slide 4, so what we did was we took a look at all the active funds that are out there since 1995 through 2019 and said, let's just take a look at the ones that throughout their entire performance track record, those are the ones that outperformed. So we're just looking at outperforming managers that have at least 10 years of a performance history, and they've outperformed. So then we said, well, let's take a look at how that journey of performance looks like. And of all of those outperforming funds, more than half of them, in fact, 60% of them, at one point in time, were 20% behind their benchmark. I mean, think about that. That is a very meaningful amount of underperformance, yet over the course of their entire lifetime, they did outperform. More than half were also more than 20% behind their median. So I think, one takeaway is that in fact, we actually wrote a paper about this. It's the bumpy road to outperformance. So if you are going to go active, you have to have the mindset. I always like to say the only thing you know for sure about active management is at some point it will underperform. We also took another look at, so that's kind of the magnitude, the up and down magnitude. We also took another look at consistency. So in a different study in 2019, we found that funds that have outperformed in a 15-year time period, over half of them had at least 3 years in a row where they underperformed. So, so it's just setting the context for patience. And then one other thing that comes up is, shall we say, is this a really good opportunity in the market? What do our managers think? And we have lots of different managers with lots of different styles. So if you turn to slide 5, we thought it would be interesting to just go through a couple of different quotes from a couple of different managers. The first quote is from a value manager. Value manager we've have been using for more than 15 years. And their perspective is, we're facing an environment where, the spread between the cheapest stocks and the most expensive stocks are at record levels. We believe we'll be reaping the rewards with time. We've only in extreme crises that we've seen these type of disparities. And then we picked a quote from a growth manager, again, another manager that we've had for more than 15 years, because I know there was some discussion on, well, gee, a lot of the very large companies in the index are really driving performance and growth. And according to this manager, as some companies accelerate, others are shaken out, and we really aim to manage risk of distraction. We're really trying to find those exceptional companies, and with that in mind, we continue to search for companies that are disrupting the future, and we own them in size, maintain conviction, and hold them for the long term. So the reason why we showed both of these quotes is nothing is really obvious, I would say. There's always going to be different views and perspectives in the industry, and that's what really makes active management potentially rewarding, but it's also something that's not easy to do and not easy to enact. So with that, I wanted to spend the time on slide 5, slide 6, and just pose a few questions to get you to think about, well, should we have active? Is now the time to move the passive? I think, in reading the transcript and the prep from Robin, it seems like these are some of the questions that are on your mind. And I thought maybe a framework to help you think through this is, more the active passive decision, and then, well, is now the time to move? So kind of breaking it up into a couple of different categories. So focused on the active passive decision, anytime you're going active, you have to believe that you have, or your consultant has, the ability to discern manager skill from luck. Second, and from what I understand, it's not just about the managers you select, it's also about how you put them together, and do they have certain biases or tilts in the portfolio, and if they're consistent based on the managers you select, then you are also implicitly making a bet on what's been termed in the marketplace certain factors. So I think I heard Robin say a little bit earlier that maybe you have some managers that will be focused on low volatility. Maybe you have some managers that are focused on value or a smaller size. And if these are consistent tilts, then implicitly you are saying, yes, we believe that these tilts will add value over the long term. And then the last question from the active passive decision, It's not just, this committee. It's the committee plus the stakeholders, whether they're your participants or whoever else your stakeholders might be. We showed some of those up and down, the bumpy road, if you will. Do you have, the patience to endure those inevitable drawdowns with active management? So I thought, maybe Robin, I'll look to you for a little guidance. I thought maybe I would pause there just to see if there's any questions before we, kind of move to the next set of discussion items.
Sure. Any questions for James?
I guess it's Natalie. I can't see myself right now, but I assume you can see me.
I can see you, Natalie.
Hi. So I like the way you're framing this. We're sitting here, you call it stakeholders. We're fiduciaries, obviously, first and foremost. And so what a couple of things you've said. One is this seems very talent dependent to me, very much, and to me, that's also a very fluid asset of these firms. So, that's of concern, obviously. And then I just lost my second thought. I'm having a senior moment on my birthday. Sorry, I'll get back to it later.
Natalie, I could, if you like, I could comment on something that you just said in terms of the fluidity of talent, perhaps, is maybe the way that you put it. Just in our experience, that's probably one of the tougher things for active managers to do is that transition, right? So oftentimes you might see maybe there's a talented group or team of managers. They are they do well, they're successful, but then what's the succession planning? And not a lot of not a lot of managers do that well. And if they don't do that well, that could be one of the challenges if you're not grooming that next level of talent. Related to this is maybe not what you were saying about talent, but that question of sustainability. I always like to say assets are kind of the silent killer of outperformance. If you have, from a manager perspective, if you always have to be careful and watch, especially in areas that are capacity constrained, like micro cap and small cap. There does come a point where if you have too much in assets, that can be a sign that, well, maybe even if you do have the talent, you don't really have the flexibility to incorporate some of those ideas. So these are all, and there's lots of other things to consider for active management. Now, all that being said, we do believe that with a dedicated process, with a focus on identifying and monitoring and having a full effort on that, it is possible. Like I said, we've been successful over the years, but it's not easy. And the thing that we benefit, I think, from is like our board of directors kind of gets it. And, our average manager tenure is 13 years. So, and it's very, I can't think of the last time we've parted ways with a manager that hasn't been around for, more than 10 years. So it's really like a top to bottom buy-in and mindset that, we're gonna really focus on the drivers of those performance and less so the outcomes and performance. So I'll pause there. Thank you, Natalie.
Great, thank you.
Any other questions? Yeah.
Yeah.
Any other
I'd like to ask-
questions on this?
Yeah, this is John. I'd like to ask a question.
Hey, John.
So
Sure.
I wonder if you could distinguish between, we're talking about US equity, and it seems like, different, essentially that large cap US equity, where most of the money is, it seems much more difficult for managers to outperform than in the less efficient small cap and maybe mid cap markets. And I wonder if you could comment on that. You mentioned size in your second bullet, but it seems like, there's parts of the market where it's really difficult to pick managers that are going to outperform consistently or over the long term, versus small cap, where I think we've had more success. And I wonder if you could address that question.
Sure. Thanks, John. We get this question often, and this is probably not going to be the answer you may expect. But in our experience, the difference between large cap and small cap is not necessarily that we see more managers or it's easier to, let's say, to identify a manager in small cap versus large cap. Really, the difference is in large cap, the dispersion of outperformance and underperformance is narrower. The dispersion in emerging in small cap is much larger. So given that there's a bigger dispersion, if you are successful in identifying an active manager in a small cap, you're likely to reap better outperformance. But if you take a step back and look at the entire universe of small cap, it's not that more small cap managers tend to outperform. In fact, if anything, especially when you're looking at a net of fee perspective, given fees for small caps tend to be a little higher, the overall universe overall probably tilts a little bit more so under performance. But so the rewards for identifying a good small cap manager can be larger, but the just by sheer picking them out of a hat, the sheer chance isn't any higher.
So just to follow up then, if the dispersion is narrower, it seems that would be an argument against active management with the less dispersion, because the reality is that even if you pick a winner, the likelihood is the winner is not going to get you that much alpha compared to a winner in the more dispersed. Is that the right word? I think so. The more dispersed. Managers, and that also extends to private markets where there's greater dispersion, but we're not talking about that today.
Yeah, so I would say a few things to build on that, John. Yes, if you, let's just assume you have skill. If you do have skill, then you probably do want to employ that skill where you can, add more value net of fees. Of course, fees are higher and small, so just being mindful of that. The other thing to consider is, what is your net of fee outperformance expectation? And I guess something to keep in mind, is more of a question for the committee. If I think I heard about 10% of the portfolio, I know 10% is the defensive strategy, but about 10% are active US relative to the entire one portfolio. So let's just say if you were to, say you can add, just hypothetically, 100 basis points, which would be net of fees, which would be, I'm sure would be top quartile. 10% of 100 basis points is 10 basis points to the overall portfolio. So I guess that's just some other, consideration as you're looking at, building this portfolio for your participants. Thank you, John.
Thank you.
I'd like to ask something about persistence, as in, what are your thoughts on how consistent the good managers are, and how inconsistent they are?
Yeah, you're asking all good questions. in I guess we have not seen any persistence where good manager, at least from a year-by-year standpoint, tends to be a good stays to be a good manager. There's probably more of that if you get into more private equity or venture cap, where you tend to see a little bit more of that persistence. But there's actually quite a bit of cyclicality. And if you're, I mean, to be candid, I mean, if you're looking at managers and trying to select managers just by looking at past performance, you were just to select past outperformers, you would probably be much better off by just sorting the universe by high cost to low cost and picking out a low cost performance randomly. You'd probably end up with better outcomes. So it's another way of saying that there is not a lot of persistence. There is a lot of cyclicality, but there are, that being said, we do believe there are some managers out there, and we've had some relationships with managers that go for decades, that we will have the inevitable ups and downs, but we do believe over the long term they will outperform.
So James, this
Yes.
is Rob. I think relevant here, and I'm mindful that we're going to run out of time soon. I think one of the questions we've been talking about with the board is the question of whether you think there's any reason to believe the next 5 to 10 years are going to be different in U.S. equities than the prior 10 years. And are you looking at managers with a different lens, or thinking about multiple equity manager structures in a different way because of that outlook?
Yeah. So thank you, Robin. I know that's a nice segue to the timing. I mean, honestly, it's almost like the longer you do this, the more humble you become. And, we are still really trying to look for, talented managers that are, continuing to improve their investment process, understanding the market, and, really looking for those managers that know who they are, know what they do. And so the short answer is we're not suddenly saying, well, we need to find managers that only do this particular style or that particular style. We think there's a lot of different approaches that can outperform in the long term. We do believe that all investment processes and styles will go in and out of favor. Diversification can be your friend here. So, I go back to the quotes before, depending on who you talk to, if you talk to a value manager, they might say, wow, these value spreads are best that I've seen in, a long time. You talk to a growth manager, it's like, well, actually, the world is changing a bit. These are, properly priced in, and we believe that, there's actually growth opportunities here. So my guidance would be, not just to think about this next step, but think about the step afterwards. So if you believe that, wow, this is a great opportunity, we should, stick with this, and they do, managers do outperform, then what's going to happen the next time and the time after that? So I would really just encourage you to, think through the process itself, as opposed to just, the one decision. And maybe I'll just leave it there.
So timing is tough. In other words.
Nothing is ever easy. Timing is particularly challenging. So we tend to just take an approach of, let's have different views and approaches and combine them together, and get some of the benefit of diversification, and knowing that each style, each process will have its inevitable drawdowns. Okay. Any other questions? I'm not sure if time, I think we're getting close to the end, but Robin, I'll take my cue from you.
And I just remembered the other part of my question, which is sort of more
Go ahead now.
Just a general, is there an expansion in this market? Like, what does this look like? Are there more and more boutique firms doing active management of in the public markets, or is it more towards private equity for those folks?
Yeah, I would call it more a hollowing out of the middle. So you either have larger firms and then smaller firms, those mid, and I say mid, call it 100 billion, 500 billion-ish range. They seem to be becoming a little bit more consolidated. Yeah, there is more opportunities going with private equity as well, but that would be the way I would describe the trend. More so, either larger firms that have multiple boutiques, or those smaller boutique firms, and the ones in the middle are becoming fewer.
And I guess, do you think that has any impact on anything?
Well, I mean, I think I think maybe what you're asking, Natalie, as well, is it getting harder or easier to outperform? Because if you have more people, more managers, and you have more competition. If you have fewer managers, well, then maybe there's less competition. So I think our take is it's not getting any easier. And, if you think about the amount of information that's out there, the talent, the bar is always rising. And we're not at the point where there's such a shakeout where there's nobody left and there's so much value to add because there's only one active manager left. We're nowhere near that. We are at a point where it's still, in our view, highly competitive, and it's challenging. And we believe that will continue to be a challenging environment. Now, challenging does not mean impossible, but it is challenging and we believe it'll always be challenging to add value.
Thank you.
You're welcome. Okay, any other questions or anything else?
I think we have a few minutes, so if you'd had any concluding remarks, James.
Or can I ask one quick question? No, I don't usually, but you rightly pointed out the importance of fees in terms of compounding investment returns. What's your thought about performance-based fees and how that may or may not help people in our position? If an active manager is willing to go for performance-based fees, does that help the case for active management in any way?
Thank you, Susan, for that. Interestingly enough, the majority of our active equity managers do have a performance-based fee. Now it's since they manage performance is a small or a portion of the base fee, but we actually are advocates. We do believe in that. So again, all of our or most of our asset managers do use that. It's interesting that it's not common, at least in the mutual fund industry. So I think on the margin that could be beneficial, but to me, it's more on the margin. It's not just because a manager has a performance-based fee, it may help on the margin a good manager, not get too greedy with assets because they know they have a performance-based fee. So again, we are believers, and we do believe it can be beneficial. Any other questions? If not, I can.
Yeah, I have one last question. Sorry.
Yeah, go ahead.
Yeah,
Steve.
this is
no
Steve from
worries.
I like the slide number 4. Obviously, all managers underperform to some extent over their life. I'm just wondering, from statistics speaking, is there any time period we have to wait to see we need to fire a manager, for example, maybe the magnitude underperformance? Or is there any like statistical analysis to say what is the best waiting period to make a decision?
Yeah, I'm not going to have a great answer for you, Steve, because there is no like magic formula in terms of, on average, if you have 3 years or 5 years, or it is really an idiosyncratic decision. Maybe I will say there are certain environments that are more favorable to active management overall than not. And those environments that are more favorable to active managers, when the largest, the mega cap stocks, the largest 5 or 10 stocks, if they underperform, or if the majority of stocks in the index outperforms, that's generally good for active management. If you're a value manager, let's say, and your style is actually not in favor, that can be a little bit of a boost on average. But again, going back to your question, Steve, we have not found an optimal guidance for parting ways with a manager after a certain period of underperformance.
I mean, James, would it be fair to say, like, when we evaluate our active managers, we go with this 5P philosophy, where it's philosophy, people, process, portfolio, performance. I think a lot of times when we're looking at performance, and correct me if I'm wrong, James, but we're looking at their overall process, and is it understandable? Is it sustainable? Is it proven? And are they following, the guidelines that they're talking to? And I think a lot of times, when we're working with our active managers, looking at what is the philosophy, who are the people within the firm, do they have a backup in place or a process in place should someone retire or leave the organization? And those are a lot of critical things that we're taking into account.
Yeah, that's right, Valerie. I mean, again, the guidance would be more to focus on the drivers, and Valerie mentioned a number of them: philosophy, people, firm, process, and then the outcomes are, what's the portfolio and what's the performance. We've actually, there are times where we actually add and have hired a manager where their their most 5 years, they had underperformance. So we really do focus on the drivers, even though the performance is the one, those are the outcomes. You have to really disentangle the outcomes from the drivers. So I think we might be close on time, if not at time. Robin, I'm looking for a cue from you.
Well, I think we are. I defer to the chair of the board in the meeting, but I think we are at time. Deborah?
Okay.
We are. Thank you so much for that very interesting presentation and for joining Teachers Retirement System this morning. Thank you again.
Well, thank you so much for the opportunity.
Thank
And if there's any other additional follow-up, we'd be happy to follow up and provide. So thank you, everyone. Have a great day.
Okay, thank you. You as well.
Bye now.
Right. Take care.
Bye-bye.
So Liz, do we want to let in the Wasatch folks?
I just let them in.
Great.
Morning.
Morning.
Good morning.
Good morning.
Hello.
Hi, this
Is
is
everyone in, Robin?
Yes, yes.
Okay,
This is the
perfect.
Wasatch team.
Welcome to Teachers Retirement System Investment Meeting. Thank you so much for joining us. You want to introduce yourselves?
absolutely. This is Chuck Stolfa. I'm the client relations manager for New York City Teachers. And with me is JB Taylor. JB is the lead portfolio manager on the small cap growth strategy that we manage for New York City Teachers.
Okay, great. Thank you. Liz, are you able to put the presentation up so we can follow along with it?
I provided Chuck and JB with co-host options, so if they want to share their screen, they have the option. If not, I have the slide and presentation ready to go.
Okay, great.
That sounds great. I think what we'll do is we'll take over and JB will share his screen so we can show the presentation if that's okay.
Thank you. Yes.
Great. Well, we're happy to get started. Should we jump right in?
Please.
Okay, excellent. Well, thank you very much for having us. We always appreciate the chance to talk with our clients, and it's a great topic to talk about active versus passive. So we're looking forward to talking with you today. Just a quick reminder about who we are at Wasatch. So we are an active manager, and we focus primarily on the small and micro cap public company space. So we invest in companies here in the U.S. and internationally. And for you, we do that through the small cap growth portfolio that JB manages. And then we also manage a microcap value portfolio for you as well. So we appreciate that trust you place in us to manage those assets for you. We've been managing these assets and focused on the small and microcap space for 45 years. JB's been with Wasatch for 25 of those years. So we have a lot of history and a lot of experience understanding markets and understanding how we as active managers can look for opportunities where we can essentially outperform the passive benchmarks over the long term. JB in particular has spent probably more time than anyone else on the research team at Wasatch looking into what some of these opportunities are. And we've got some insights that we think are really interesting that are worth sharing with you today. So I'll turn it over to JB, and JB will go through our presentation.
Great. Thank you for the opportunity to present this morning and give some thoughts on the case for active versus passive management. And I'd be the first to admit that if that is the topic before the court, let's say, I'm the last thing that could be called an impartial witness. So I've spent the last 25 years as a stock picker on the ground, I'd say in the field, sifting through all different types of market opportunities. It's what we love to do. Sifting through opportunities, looking for just what are the best companies where we can harness growth over a long period of time and watch returns compound. And so I think I can make a couple cases today. One is that certainly an active manager with a disciplined strategy, the right incentives, and a long-term time horizon can beat passive benchmarks consistently. And then also, I think I can make the case that especially today, I would be wary of passively investing in one of these large benchmarks because of the way the market has set up, especially if an investor expects future returns to match what's happened in the recent history. So here's just one way that we look at why active managers and an active manager like ourselves has plenty of opportunity to beat the market and beat the benchmarks. And we call this slide opportunities always exist. And what this is a slide that shows for the Russell 2000 index, so the best benchmark for the small cap US market, roughly 2,000 companies. It shows what percent of companies every year going back for the last 30 years have gone on to grow their revenues at better than a 20% clip over the subsequent 5 years. So at a compounded 20% growth rate, which means these companies are more than doubling in a 5-year period. just really great growth. And what it shows you is at any time over the last 30 years, it doesn't matter what type of economic environment we've been in, you've had anywhere between, say, 8% and 16% of these 2,000 companies go on to do this. And so 160 to 300 companies out of 2,000. And when you're a long-only manager investing in a fairly short list, say 60 to 80 investments with low turnover, you only need 10 to 15 new companies each year to invest in your portfolio. And so 160 to 300 really fast growth companies is an exciting opportunity to take advantage of. And why it matters is that the returns from simply that high growth group are phenomenal. So here are the rolling 5-year returns for the last almost 30 years for every single year of just that high growth group over the subsequent 5 years. And as you can see, at a minimum, this group is getting 1,000 basis points a year in extra performance versus the benchmark. And so you'd have to be perfectly clairvoyant to know exactly which are the future growers to invest in this group. But what it tells you is that there are plenty of opportunities to harness. Now it's worth flipping the last 2 slides on their head and thinking about kind of the inverse. So if 8 to 15% of the benchmark is consistently in these very fast growers that will have phenomenal returns, what is the rest of the market doing? And what it tells you is that there's about 50% of the index at any given time is growing less than 5% revenue growth over the subsequent 5 years, and the returns there tend to be negative. And in fact, the entire balance of the market, if you take the market outside of this high growth group, trails the benchmarks consistently by about 300 basis points a year. So the market itself, just to create its returns, has to have this high growth group. So I think it begs the question is, you can invest in the entire benchmark, which will give you access to that 8 to 15% of the high growth group, but in very tiny weights. But then you have to take all of the rest, which compound at negative returns or market trailing returns, or you can focus as an active manager on those companies that are doing something special over the subsequent 5 years, and just focus on what you know is going to be a high return opportunity. I think it's also worth thinking about when you think about the benchmarks, how they're constructed. So basically the weights in the benchmark are using the market values today, and which are generally representations of the current earnings power of companies. And investing, in order to compound returns over long periods of time at phenomenal rates, you need to think about the future. And the benchmarks don't think about the future. And so it's why you get in the benchmark, you'll have large weightings in materials companies, very slow growth industrial companies, slow growing banks. There's about 300 banks in the Russell 2000 index. And as my partner likes to say, if I can't over a 5-year period pick a stock that can beat a slow growing bank, you ought to fire me. And that's how we feel. There are just so many companies in the index that just are not interesting because of their slow growth, low quality nature. There are something that most investors don't realize, that an investor investing in the Russell 2000 today is investing in an index that has almost 30% of its weight in companies losing money. Now, some of those companies are losing money because they're investing heavily in great growth opportunities and will be great growth companies in the future, but it's a small fraction. Most companies are losing money simply because they're poor companies that won't make money in the future. And so an index investment is basically accepting that, whereas an active investment is more of the idea of sifting through all those opportunities, figuring out which are the companies that have great growth, and really, if you think about going to where the puck is, going where the puck is going, not where the puck is today. And so that's how we think about the opportunity set and how the construction of the index, and why we would never just settle for investing in all of these average companies that are in the market. If you go to the next slide, this touches on some of my thoughts on why I would be wary of investing in a broad market index today, especially if the expectations are that the forward returns match something that of what we've experienced in the past. So here's a 20-year look at the fundamentals of companies in the Russell 2000 index. And it's split into three parts: the growth of companies, the revenue growth of companies, how those companies are priced in the market, and then a metric of quality. So this is an ROA metric, but one could think of that as the financial robustness of companies and their cash flows. And what you've seen is over the last 20 years, which has been a great market return environment. So the Russell 2000 has compounded at better than 8% over that 20-year period. But we've had really a regime change in terms of the fundamentals of companies in the US economy, really with the pre-global financial crisis era and the post-global financial crisis era. And in the pre-GFC era, what you saw is we had higher growth. So companies on average in the US economy in the small and mid-cap area were growing on average of 9% per year in terms of revenue growth. And in the post-GFC era, that growth rate has been lower. So there were significant dents to our economy that we've continued. We talk about a sluggish recovery in the US economy that's taken 10 years, prior to COVID kind of denting it again. And that's been a function that you see that in these numbers. At the same time, the quality of companies, the average quality of companies in the US economy, represented by the Russell 2000 index, is significantly lower, the third chart at the bottom, where the average ROA is significantly lower than what it was pre-GFC. But at the same time, and we could talk about the different reasons, probably lower interest rates, fewer investment opportunities elsewhere around the world, meaning the US has been still maybe the best house in the neighborhood. The valuations of individual companies have continued to be richer, meaning that these companies are priced more dearly and have continued to be more expensive, even though they've had slower growth and lower quality. And so an investor today investing in the Russell 2000 index, but the same comments can be made about many of the broad indices, both in the US and outside the US, is that an investor today in the index is getting a slower growing batch of companies that are more expensive and with lower quality and lower financial robustness. Page 7 is really kind of this accentuates this point even more. So this is the same 20-year view. And it really, what it tries to do is it shows the continued compound effect of both the underlying sales growth of all these companies in the Russell 3000. So this is a broader look, including large companies in the US, but then the effect that increasing valuations have had on stock prices. So if you take the top of the dark blue line, that is the market over the last 20 years. And then what we've done is with the light blue line, we've indexed what the sales growth of companies in the US has been over the last 20 years. And so as that light blue line continues to grow, you'd expect the market to grow. And the difference of steepness in that dark blue line would be how much of the return in the market has been simply because higher prices are being paid for the same stocks. And so if you look back in that 2002 to 2007 period, the market was increasing, but the thickness of that dark blue line was pretty constant, which means that the returns from 2002, 2003 to 2007 were largely driven by sales growth. You had the GFC period where the market dipped and the market dipped precipitously below that sales growth trend, which means the market was incredibly cheap. And then it rebounded. And what you've seen is slower growth in the light blue line since 2010, but really steep growth in the market, which tells you that it's just higher and higher prices being paid for the entire market over the last 10-year period. Now, again, lower interest rates are probably the largest driver of this, but it begs the question, can this go on indefinitely? Probably not. And the way we think about it is that eventually fundamentals of companies have to drive stock market returns. And so we should expect, because of the slower growth nature that we see in the overall US economy, we should expect lower returns generally, but that doesn't mean that there aren't still hundreds of opportunities each year in the Russell 2000 index with much faster growth that will justify much higher prices and price returns going forward. Wasatch, these are a couple slides just showing that this is how we approach the market. If we compile a portfolio of companies growing much faster, then we believe that those fundamentals will justify higher returns than the benchmark. This just shows what our average growth rates of our portfolios have been over the last 20 years compared to the market. Ours is the higher line, and that's consistently resulted in better returns. This is an important point of why active management is necessary to capture this phenomenon. This is a 10-year view of what happens if an investor simply went out and tried to buy the top decile of companies that have historically grown. So this is what the forward 1-year returns look like of a batch of companies that are in the top 10% of all companies in terms of their last 1-year revenue growth rate. And what you see is that alpha, all those negative numbers, shows that you can't simply buy historically the good growers and expect them to generate good returns going forward. There are periods where it's worked. The last year has been a very growth favored environment, and it has been over the last year one where alpha has been generated simply by buying the past growers. But generally this does not work, and we wouldn't expect it to work over long periods of time. What it tells you is if you can predict the growth, this is a chart that shows that what the 1-year forward return is if you predict what the top decile growers are going to be over the subsequent year, the alpha is consistently very high. And it takes active management to do that. Reminder, a benchmark can't take advantage of changes in the environment. A benchmark can't take a situation like in COVID, when there's a couple aspects to that. One is when market prices are incredibly on sale, the benchmark doesn't have a long-term time horizon and doesn't think about how heavily discounted suddenly great companies are, and isn't able to jump in with higher weights and buy those companies for the long term, as we've done. A benchmark can't anticipate where the puck is going in terms of big changes in the economy. COVID, in addition to the market stress that it placed on the system, it rearranged and potentially rearranged many segments of our economy that will look quite different 2-3 years from now. And an active manager is thinking about those things, as we are, and about where the growth will be. And it's a tremendous advantage to not be held to historical weights the way the benchmarks are constructed. Similarly, a benchmark each year in June rebalances, and often those companies that get to be the highest weights because they perform the best, maybe just as they're about to break out and start to exert even larger competitive advantages on their industries with greater market share take, the benchmark cuts those weights in order to resize the benchmark. And that's not what a good active manager would be doing. They might be adding to those weights as a company is getting even stronger. The next couple charts speak a little bit to time horizon. And I think this is an important point. And I think we have to recognize that one person's short term is another person's long term, or vice versa. And so this is a chart that shows how our returns were from the third quarter of 2015 to around the summer of 2017, and we didn't look good. And so over that period, about 400 basis points of annualized underperformance. And I think about, had we been onboarded as a new client in the summer of 2015, that client, after 2 years would be saying, hey, we're expecting you to beat each year by 300 basis points and we're underperforming by 400. why did we do this? And what is your value? And the case we made at the time for clients, and luckily many clients had known us for a long period of time and knew our strategy, is that we were compounding revenue growth inside our portfolio and earnings growth, meaning our companies were performing well. But things change in the market where maybe the market was enthralled with another sector of the economy. Maybe some of our companies were just simply taking a valuation break as their companies continued to build value. What you find is that active managers tend to deliver their alpha in chunks, and it's not expected to be consistent every single quarter or even every single year. And so we showed at that time, over that 2-year period, how here was the Russell 2000 sales growth over that 2-year period, which roughly matched what the return of the Russell 2000 was. And then here was our sales growth over that 2-year period, significantly better, even though our stocks at that point were not getting paid for that better sales growth in the portfolio. If you fast forward to the 3-year period after that period, you see that all of a sudden the market kind of woke up to the exceptional growth that was in the portfolio and started to value these companies higher, and the returns showed up with and more than made up for that period of underperformance with a 22% annualized return versus a 4.5% return over that period. And again, we can show that, hey, this return was generated and rightfully delivered because of the revenue growth in the portfolio, with our revenue growth over that period compounding at an exceptional 19% compounded rate. Here again shows that on page 18, it shows that over the last 3 years, it's been revenue growth that has driven the outperformance of the portfolio, whereas in the market, the return has been has also been revenue growth driven, but because that revenue growth is so much smaller, the returns have been less. So all of this just gets to the point that an active manager, if they're focused on the fundamentals of individual companies, has plenty of opportunities to pick and choose from. And if they harness those opportunities, they should achieve results that are much better than the passive index. Here are some slides that just show about how we're weighted in the market and how an active manager might be weighted versus the Russell 2000. Again, it speaks to how benchmarks are crudely constructed. 17% of the market is in financials. We have 23% of the benchmark is in others, which includes commodities, energy companies, slow-growing industrials, manufacturers, and where an active manager would want to be is in areas that are growing in the economy, like in tech, in healthcare, in smart or tech-enabled industrial companies, in consumer companies where so much is changing in the consumer environment as so much is being purchased online and no longer in brick and mortar stores. And an active manager can weight towards those growth areas of the economy. And that's been profound for performance. If you've been in the right sectors, you've been performed much better. That is really the kind of the basis of my active versus passive argument, that opportunities are so plentiful in these broad, diverse markets that passive markets may not perform, or passive investments and benchmarks may not perform quite as well as they have, because so much of the last 10-year return has been driven by valuation increases and not necessarily by the fundamentals of the companies. And we expect that the fundamentals of the companies to be more or less similar going forward than they have been. But the valuation increases, we think it's harder to argue that those will increase. And I'd love to open it up for questions and see what you're thinking about.
Okay, do any trustees have questions? Or this was very interesting. Thank you so much. Made a lot of sense. Questions from trustees?
I have a question.
Okay. Mr. Adler, go ahead.
It's John. So fascinating presentation, really great, and appreciate the returns that you've delivered for TRS. My question is, you focus on the comparison to the Russell 2000 overall, but you are a growth manager, and so those combinations include value stocks. Could you, obviously you don't have slides about it, but could you talk about how your, how your metrics compare to the growth index, the Russell 2000 growth? Because like when I see your sector weightings, it obviously includes a lot of value pieces, and I'm not sure how it compares to the growth index.
Yeah, so yeah, it's a great question and good observation. So our growth is generally even higher than the Russell 2000 growth, with much higher quality. So that stat that I gave, about 30% of the Russell 2000 being in companies losing money, that's even in a higher percentage of the Russell 2000 growth. And we focus on companies that are growing quickly, but generating cash flows while they grow, which is an even rarer set. And so this wasn't intended as a Wasatch, our strategy necessarily versus the benchmarks. I was trying to make it an active versus passive discussion, but our metrics, you'd make the very same argument in terms of better fundamental growth, less reliance on valuation increases, and a focus on higher quality companies. That's always been the Wasatch method or process. All those arguments would be the same.
Can I just ask a follow-up, which is, you guys invest in the small caps, and you're, it's my impression, I mentioned this before, that small cap is a part of the market where there are more inefficiencies that you can exploit as an active manager. Do you believe that your thesis would apply as well to the Russell 1000 as opposed to the Russell 2000, or the larger cap part of the universe?
It's a great question. I think if an active manager, when you talk about the Russell 1000, if an active manager is willing to hunt the entire 1000 and willing to be truly active, yes, I believe this is true. I do believe it's a great point, John. I would agree that as you go higher up the cap spectrum to, let's say, large and mega cap, it's very difficult. And I'm just speaking as an opinion of one. And the way I think about individual companies and harnessing the growth of individual companies, it would be harder for me to get an edge on a company like Microsoft when I believe everyone's looking at Microsoft. But the real issue with active versus passive at that size is that, it opens the discussion of why don't, because I don't want to overlook the fact that, there's studies that show that active managers on average don't beat benchmarks. And it's worth digging into why that is. And one of the reasons is there's many active managers that aren't active. They are playing not to lose as opposed to playing to win. And so this is a hard, even presentation for me to give, because the amount of time I spend thinking about the benchmark ever is quite little. And so, because I just know there's so many opportunities, and what I'm interested is in the next great company. But if a large cap manager, if 5% of the index is an Apple, and they're thinking whether they own, how much Apple they own, and even if they own 5%, they're just taking a market bet in Apple. And that's just quite different than how. So long answer to your question, I believe that for the vast majority of the market, meaning that there's so many indices, that this approach is valid. And this line of thinking is valid. When you go internationally, the number of companies that are available to invest in multiplies versus the benchmark, and meaning there are just thousands and thousands of companies to invest in the small and medium mid-cap sizes. And this is certainly the case. So barring, excluding large and mega cap, yes.
Thank you.
Okay, any other trustee questions? All right, Robin, do you want to jump in for anything?
No, no, I think that was a very interesting presentation, and appreciate Wasatch's participation in the call.
Yes, thank you so much. It was very interesting. Okay.
Well, it's our pleasure. Thank you for the opportunity and hope everyone's well and safe. Thank you.
Thank you. Thank you very much.
Thanks, everybody. Take care.
Bye-bye.
Bye.
Okay, do I hear a motion to leave and go into executive?
Moved.
Thank you, Mr. Kazansky. Do I hear a second?
Second.
Thank you, Susanna. All those in favor, please say aye.
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 Okay, any opposed?
Aye.
All right, we are going to, Liz, are we leaving or do we have a link? or are
You
we
can
staying
actually
right here?
stay. No, you can actually stay here.
Okay, perfect. We're back in public session. Susan, will you please report out?
Certainly. In executive session, we received a presentation from a vendor. And then there was a discussion about next steps regarding how to use this presentation and other presentations and data and how it can be used to formalize a policy.
Thank you so much. Okay, anything else anyone wants to add? Perfect. Do I hear a motion to adjourn?
So moved.
Thank you, Mr. Brown. Do I hear a second?
Second,
Second.
Thank you, Mr. Adler. All those in favor, please say aye.
Aye.
Great. Any opposed? Okay, again, a very happy birthday to Natalie and to Thad, and everyone stay well. Thank you so much. Bye-bye.
Thank you.
Thanks,
We're
everybody.
adjourned.
aye.
Bye-bye.